The global gold market is witnessing a significant transformation as the control and pricing power, long held by Western institutional investors, begins to migrate east. This shift is reshaping the landscape of the precious metals trade and holds deep implications for the global economy. Recent surges in gold prices, reaching new all-time highs, signal a change in the dynamics of the market. Unlike in previous years, where the dollar price of gold was the main focus, the current narrative delves deeper into the underlying shifts in market control and demand. Gold has long been used as a benchmark for international trade and as a global store of value. But the Bretton Woods Agreement's 1971 suspension of the dollar's convertibility into gold signaled the start of gold's evolution as a commodity traded through futures contracts and derivatives, heavily influenced by Western financial institutions. According to a Russia Today report, the traditional trends in the gold market are now breaking down, as demand for physical gold, particularly from Eastern central banks and private sectors in countries like China, begins to outpace the speculative paper gold market prevalent in the West. This growing demand for physical gold is reducing the influence of Western institutional investors over gold prices, indicating a shift in the market center of gravity towards the east. This shift carries profound implications for the global financial system. Central banks, especially in China, have been purchasing gold at record rates, a move seen as a strategy for de-dollarization amidst increasing concerns over the weaponization of the dollar and the U.S. debt crisis. The acquisition of physical gold by these banks is seen as a hedge against potential debasement of fiat currencies, particularly the dollar. Physical gold is becoming more and more preferred over paper claims and derivatives, which suggests that gold is once again playing a major role in the financial system. The BRICS nations' steady departure from the dollar in international trade emphasizes this shift even more and points to the potential return of gold as a neutral reserve asset for resolving trade imbalances. Despite these significant shifts, Western investors have been slow to adapt, continuing to sell gold in response to rising interest rates in favor of other assets. This trend, juxtaposed with the relentless pace of gold acquisitions by Eastern central banks, highlights a potential underestimation by the West of the ongoing transformations within the global gold market. The migration of gold from the West to the East not only represents a wealth shift but also a turning point in the financial world. In addition to protecting their economy against currency depreciation, Eastern countries are undermining the Western world's long-standing financial hegemony by gathering gold.